In October 2019, SoftBank Group watched one of the most valuable startups in the world collapse in real time. Within weeks, WeWork went from a $47 billion valuation to less than $8 billion. Its IPO was canceled, its founder was pushed out, and investors began asking a terrifying question. What if the problem wasn't just WeWork? What if the problem was the system that created it? Because behind WeWork was something even bigger. A $100 billion investment machine called the Vision Fund, created by SoftBank founder Masayoshi Son. The Vision Fund had flooded Silicon Valley with more capital than the tech industry had ever seen before. Billions went into startups that were losing billions. Companies stopped competing on profits. They competed on growth, on expansion, on valuation, on narrative. And for a few years, it looked unstoppable, until the entire model began collapsing under its own weight. Because this wasn't just a tech bubble, it was a decision. And that decision would erase tens of billions of dollars, destabilize the startup ecosystem, and permanently change how Silicon Valley thought about money. To understand what happened, you have to understand what SoftBank used to be. SoftBank Group was founded in 1981 by Masayoshi Son in Japan. At first, it was a software distributor, but Son wasn't building a normal company. He was building an investment empire. In 2000, SoftBank invested roughly $20 million into a small Chinese internet startup called Alibaba Group. That investment eventually became one of the greatest venture capital bets in history. At its peak, SoftBank's Alibaba stake was worth more than $150 billion. The success transformed Masayoshi Son into a legend. By 2016, SoftBank had acquired British chip designer ARM Holdings for $32 billion. Then came the Vision Fund. Announced in 2017, the Vision Fund launched with nearly $100 billion in capital. It was the largest technology investment fund ever created, backed by Saudi Arabia's Public Investment Fund, Abu Dhabi's Mubadala, Apple, Qualcomm, Foxconn, and others. The fund operated at a scale Silicon Valley had never seen before. Traditional venture capital firms wrote checks worth millions. SoftBank wrote checks worth billions. By 2018, the Vision Fund had invested in companies like WeWork, Uber, DoorDash, Slack, Coupang, OYO, Grab. At one point, SoftBank-backed companies represented an enormous portion of global venture capital activity. And the money changed behavior. Startups no longer optimized for sustainability. They optimized for expansion. The philosophy was simple: dominate the market first, figure out profits later. For years, it looked genius. Valuations exploded, private markets overheated, founders became celebrities, and Masayoshi Son became the man financing the future. For a while, he looked untouchable. But by 2018, the cracks were already forming. The tech industry had entered an era of cheap capital. Interest rates remained historically low after the 2008 financial crisis. Investors were desperate for growth, and SoftBank accelerated the trend dramatically. The problem was scale. When startups suddenly received billions instead of millions, discipline started disappearing. Companies expanded faster than operations could support. Marketing spending exploded. Losses became normalized. Some startups began prioritizing valuation growth over business fundamentals. And internally, concerns were growing. Analysts questioned whether the Vision Fund was inflating private market prices. Competitors complained that SoftBank-backed companies were using massive cash reserves to subsidize prices and destroy rivals. In ride-sharing alone, companies like Uber Technologies and Grab burned billions competing for market share. Meanwhile, WeWork became the clearest symbol of the excess. By 2018, WeWork had lost nearly $1.9 billion in a single year, but SoftBank continued investing. At one point, SoftBank had committed more than $10 billion into the company. The logic was always the same: growth justified everything. But public markets were beginning to disagree. When Uber went public in 2019, investors immediately questioned its path to profitability. Its stock struggled after IPO. Then came WeWork, and suddenly, Silicon Valley's growth at all costs model faced its first major stress test. Leadership inside SoftBank knew they had to defend the Vision Fund strategy. The question was how. Masayoshi Son believed scale itself was a competitive weapon. That belief became the core strategy behind the Vision Fund. In Son's view, technology markets were becoming winner-take-all. The company that expanded fastest would dominate the industry. And once dominance was achieved, profits would eventually follow. On paper, the logic made sense. Network effects reward scale. Market leaders often become monopolistic. Aggressive expansion can eliminate competitors before they mature. And with interest rates near zero, capital was unusually cheap. So SoftBank made a massive bet. Instead of funding startups conservatively, it flooded them with money. Huge amounts of money, sometimes more capital than companies even asked for. Former founders later described receiving investment offers worth several times larger than expected. The strategy changed Silicon Valley psychology. Founders were encouraged to think bigger, hire faster, expand internationally, subsidize customers, capture market share at almost any cost. But strategy rarely fails in PowerPoint. It fails in execution, because massive funding can distort incentives. When companies receive too much capital too early, efficiency often disappears. Teams expand faster than management structures. Spending detaches from accountability. Growth becomes performative. And nowhere was this more visible than WeWork. Under founder Adam Neumann, WeWork expanded aggressively across the world. The company leased enormous office spaces, signed long-term obligations, and marketed itself as a technology revolution instead of a real estate business. SoftBank supported the vision. The larger WeWork became, the larger its valuation became. At its peak, private investors valued WeWork at $47 billion, but the underlying business remained deeply unprofitable. Then the IPO filing became public, and the market finally saw the numbers: losses, governance issues, conflicts of interest, unsustainable economics. The narrative broke almost instantly, and once confidence disappeared, the entire system started unraveling. The reaction was immediate. WeWork's IPO collapsed in spectacular fashion. Within weeks, its valuation fell from $47 billion to under $8 billion. Adam Neumann resigned as CEO. SoftBank was forced into a multi-billion-dollar rescue package to stabilize the company. The financial damage spread quickly. In 2020, SoftBank reported one of the largest losses in Japanese corporate history. The Vision Fund lost roughly $18 billion during the fiscal year. Several high-profile investments struggled simultaneously. Uber's stock traded below IPO levels. OYO faced operational challenges. Other startups began cutting costs aggressively. Suddenly, investors across Silicon Valley started rethinking the growth at all costs model. Profitability mattered again. Efficiency mattered again. Cash flow mattered again. And then global conditions became even harder. As interest rates later increased in the early 2020s, cheap capital disappeared. The environment that had fueled Vision Fund expansion no longer existed. technology valuations across the industry fell sharply. By 2022, SoftBank reported another massive vision fund loss, exceeding $27 billion across consecutive quarters. Masayoshi Son dramatically reduced investment activity. The company shifted from aggressive expansion to defensive preservation. What was meant to accelerate technological dominance had instead exposed the dangers of excessive capital abundance, and the impact extended far beyond SoftBank itself. The Vision Fund had changed startup culture. For years, founders had been rewarded primarily for growth metrics. Now, investors demanded sustainability. Entire sectors recalibrated, hiring slowed, valuations compressed. Startups prioritized efficiency over expansion. The era of infinite venture capital was over, and Silicon Valley would never operate quite the same way again. So what went wrong? It came down to three things. Lesson 1. Capital can amplify bad strategy just as easily as good strategy. SoftBank believed money itself could accelerate dominance, and sometimes it could. But excessive funding also removed operational discipline. Businesses often confuse growth with strength, but growth without efficiency creates fragility. When external conditions change, fragile systems break quickly. Lesson 2. Incentives shape behavior more than vision does. The Vision Fund rewarded aggressive expansion, so companies optimized for expansion, not sustainability. Strategy doesn't fail because leaders lack ambition. It fails because incentive structures encourage the wrong behavior at scale. When valuation becomes the primary target, fundamentals often become secondary. Lesson 3. Timing matters more than confidence. SoftBank's strategy depended on an environment of permanently cheap capital. That environment didn't last. Markets don't reward boldness alone. They reward alignment with economic reality. And when interest rates changed, the entire logic behind growth at all costs started collapsing, because in the end, business models are not tested during easy money. They are tested when money becomes expensive. Back in October 2019, WeWork looked like the crisis. But WeWork was never the full story. It was the symptom. What really collapsed was an era where capital became so abundant that growth itself started replacing discipline. SoftBank didn't just fund startups. It changed the behavior of Silicon Valley. Because in business, one decision rarely destroys an entire system, but enough money behind the wrong incentives can change everything.
So that's it. For more business stories, more hidden patterns, like and subscribe to The Firm Lore. And also, don't forget to let us know your opinions in the comment section.